Hello again, fellow BeachBum traders. In this relatively short video, we're going to explain what is called the September effect, also sometimes referred to as the September Swoon, and why this September effect or September Swoon makes September historically the worst month for investing. And we'll also talk about how this may affect your investing and or trading strategies and decisions. And hopefully this will help you then make better investing and trading decisions in the month of September to help you succeed in your trading career. So let's get started. So why do people say that September is the worst month for investing? Well, we'll look at why people say September is the worst month for investing using this article from Investopedia. I'll leave the direct link to this article from Investopedia in the description box below. And we can see why do people say September is the worst month for investing. Often in financial media, you'll hear people reference specific times of month, year, etc. that are typically bullish or bearish. One of the historical realities of the stock market is that it typically has performed poorest during the month of September. Stock Traders Almanac reports that on average, September is the month when the stock market's three leading indicators usually perform the poorest, and this is often referred to as the September effect. So what are some of the key takeaways from this article? Since 1950, the Dow has averaged a decline of 0.8%. The S&P has averaged a decline of 0.5% during the month of September. And this is essentially an anomaly unrelated to any other market event or news. Another point to particularly note is this is a worldwide phenomenon. It's not just a U.S. market phenomenon. So again, one would expect all of the global markets on average historically to decline in the month of September. Analysts consider the negative market effect to be attributable to seasonal behavior, bias as investors make portfolio changes to cash at summer's end. Another key takeaway from anything like this using historical data is that although the average in history has been that September is the worst month to trade or invest, it doesn't mean that this particular September is going to be down. Again, history doesn't always play out in a given instance, but this is the average. So, understanding the September effect. Okay, so understanding the September effect, they're pointing out from history from 1928 through 2021. On average, the S&P index has averaged a 1% decline during the month of September. This average exhibited over many years, and September is certainly not the worst month of stock market trading every year. So again, this is a historical average. It doesn't mean that this will occur on any given year, although again, this is the historical average. They point out that this September effect is a market anomaly, not related to any particular market event or news. And they point out, again, this is being recorded as of September of 2022. So they point out that in recent years, the effect has dissipated. Over the past 25 years for the S&P 500, the average monthly return for September is approximately minus 0.4%. While the median monthly return is now positive. So the statistical average is negative 0.4%, but the mean of the statistical bell curve for returns in September is actually now positive. In addition, frequent large declines have not occurred in September as often as they did before 1990. One explanation is that investors have reacted by pre-positioning, that is, selling stock in August. So again, now everyone knows about this historical tendency for September to be the worst month for investing, and so they're preparing and positioning in preparation of that in August. So they're selling stock in August in preparation that September is going to be the worst month for investing. So are there any explanations for this September effect? Firstly, it's not limited again to U.S. markets, but associated with some worldwide markets. So this is not a U.S. only occurrence. It will affect other global markets, and so trade global markets, etc. accordingly. Some analysts consider the negative effect on markets to be attributable to seasonal behavior bias, and as investors change their portfolios at the end of summer to cash in. So again, repositioning portfolios, and therefore they're attributing that to the September being the worst month for investing. Another reason could be that most mutual funds cash in their holdings to harvest tax losses. Another particular theory points to the fact that summer months usually have lightly traded volumes, sometimes called the summer stock market doldrums, as a good number of investors usually take vacation. Again, they're talking about global markets. A lot of Europeans, etc., take August off. So again, people are coming back from vacation and not actively trading during that downtime. And now they're coming back in September and repositioning their portfolios for the end of the year. Once the fall season begins and these vacationing investors return to work, they exit positions they had been planning on selling. When this occurs, the market experiences increased selling pressure and therefore the overall decline. Additionally, many mutual funds end their fiscal year in September. Mutual fund managers, on average, typically sell losing positions before year end, and this trend is another possible example for markets' poor performance during September. So again, if many mutual funds are ending their fiscal year in September and they have losses, tax losses, they're going to sell, applying downward pressure on any holdings within those mutual funds. What is the September effect? Well, we'll take a look at what they call the September effect using this article from Investopedia. I'll leave the direct link to this article on the September effect in the description box below. So we can see the September effect refers to a historically weak stock market returns for the month of September. This is a statistical case for the September effect depending on the period analyzed, but much of the theory is anecdotal. Generally believe that investors return from summer vacation in September, ready to lock in gains as well as tax losses before the end of the year. There's also a belief that individual investors liquidate stocks going into September to offset schooling costs for children. As with many other calendar effects, the September effect is considered a historical quirk in the data rather than an effect with any causal relationship. So there isn't any direct cause for this. It's just a statistical historical anomaly, but historically, based on the data, it tends to be true. So understanding the September effect is real in the sense that an analysis of the market data from the Dow shows that September is the only calendar month with a negative return over the last 100 years. However, the effect is not overwhelming and, more importantly, is not predictive in any useful sense. If an individual had bet against September over the last 100 years, that individual would have made an overall profit. If the investor had made the bet only in 2014, for instance, that investor would have lost money. So again, although this is a historical effect on average, it cannot predict the return in a given month for a given year. So like the October effect, the September effect is a market anomaly rather than an event with a causal relationship. So again, there's no direct cause that we can attribute to it, but it is a historical anomaly in the data. In fact, October's data set's positive despite being the month of all the panics, the market crashes, etc. Month of September has seen as much market turmoil as October. It was the month when the original Black Friday occurred in 1869, and 2 subsequent single-day dips occurred in the Dow in 2001 after 9/11 and in 2008 as the subprime crisis ramped up. So we can have these market crashes in any given month. It's not particularly just October, etc. However, according to market realists, the effect has dissipated in recent years. So again, this is being recorded as of September of 2022. Over the past 25 years, the average of the S&P has been only negative 0.4%, with the median monthly return being positive. So the statistical average over the past 25 years is negative 0.4%, but the statistical median of the bell curve is actually positive. In addition, frequent large declines have not occurred in September as often as they did before 1990. One explanation is that investors have reacted by pre-position, that is, selling stock in August. Okay, so again, this is a commonly known historical average in the data, and therefore educated traders, informed traders are aware of this and position their portfolios in preparation for the September effect in August, so it mutes that effect to some degree. Explanations: the September effect again is not limited to U.S. markets, but associated with markets worldwide, so this affects other global markets as well. Some analysts consider the negative effect to be attributable to seasonal behavior bias as investors change their portfolios at the end of summer to cash in. Another reason could be most mutual funds cash in their holdings to harvest tax losses. So again, many mutual funds, their end of fiscal year is the end of September, and so they're taking tax losses for that year, which is applying downward pressure on the holdings of those various mutual funds. So again, all of this helps us understand what is the September effect and how can that affect your trading. So what is what they call the September swoon, and is this a real thing? Well, we'll take a look at what is the September swoon and is it real, using this article from Synovus. So again, in this article, they say the September swoon is a seasonal trend in the stock market and one that's been well documented by researchers and the press. The fact is, September has historically been the worst month on the calendar for stocks. So since 1950, the month of September has seen an average decline in the Dow of 0.8%, an average decline in the S&P of 0.5% during September, and an average decline in the NASDAQ of 0.5% during September since 1971, when the NASDAQ was first established. So seasonality is based only on the analysis of years of historical data. So a seasonal trend is discovered if a pattern emerges in this analysis in terms of average performance in a certain month. It's important to remember, however, that due to financial, psychological, and political factors, stock market behavior can run completely contrary to a seasonal trend in any given year. So again, this is based on historical analysis. It does not necessarily predict current or future behavior, but again, this is a historical trend that seems to appear given the data that we have. So because the stock market in September has shown markedly different behavior on the average for 86 years, these results are not coincidental. Again, these are statistical significant data. So there is a genuine seasonal trend. So again, is this a real thing? Yes, this is a real thing based on the historical data. So possible reasons for what's called the September swoon. So why does the stock market generally based on historical data drop in September? Economists, financial analysts have studied the topic, but no one has reached a definitive conclusion. So again, there's not a direct causal relationship or even statistically significant relationship between some event causing what's called the September swoon. But here's some of the hypotheses out there. So summer vacation. This hypothesis hypothesis holds that traders and investors are more likely to sell after returning from their August vacations or long Labor Day weekend. So again, this highlights right after Labor Day. Trading volume tends to decline during the summer, what they call the summer stock market doldrums, and then investors, especially professional investors, get back to trading in September. So also this is third quarter, so many mutual funds have fiscal years ending in the fall, causing them to sell losing stocks for window dressing purposes and also for tax loss harvesting. So this term describes the process of a portfolio manager making cosmetic changes at the end of the quarter because they list their holdings at the beginning of a new quarter. So beginning of October, if they're either closing their quarter or they're closing their fiscal year, so they want their portfolio to look good to potential investors, so they're going to sell their losers. So their list of holdings look better without poor performing stocks. So again, number of reasons why mutual funds, the holdings within mutual funds, will have downward pressure going into the end of September. So tax losses, investors begin to sell declining stocks to harvest tax loss, getting ahead of other investors who sell at year end. This hypothesis also draws support from what's called the January effect, when investors buy back the stocks they sold for tax loss harvesting. Also, tuition time. Many investors must sell large amounts of their stocks to pay for children's tuition, for example, at college, universities, and prep schools. And for most, the school year begins roughly in September. So again, back to school costs, tuition costs, etc., may be a cause for selling. Seasonal affective disorder. So a university study suggested sharp drop in the amount of daylight in New York in September might trigger seasonal affective disorder, a type of depression related to changes in seasons. As a result, according to this hypothesis, some investors become more risk averse, so risk off behavior, so they sell their losing stocks, unwilling to wait for things to get better. So cultural trends, summer vacations, back to school, regulations, taxes, third quarter, tax losses, and even psychological effects of weather, seasonal affective disorder have all been offered as explanations for this strange September market trend, the September Swoon. Unfortunately, none of these explanations has been proven. So frustrating researchers who seek for patterns in the stock market. Maybe each of the factors contributes to the trend. No one really knows the reason for the September swoon. So if someone discovered a convincing explanation, would this help? Well, probably not. Savvy investors might jump the gun, selling stocks in August, which we've seen. It's muted the effect because it is well known now. So savvy investors, educated, informed investors may front run and sell in August to avoid the September swoon. And then others might try to beat them by selling in July. So again, you get subsequent trying to front run. Of course, the seasonal September pattern when they disappear, replaced by some other trend. So again, we may see other trends emerge as more people get financially educated in investing. But even if there is no proven reason for the September swoon, should an investor make changes anyway because of the seasonal trend towards declining stocks in September? You might be inclined to alter your portfolios. However, the September swoon is based on a historical average. It's the average performance of the stock market since before the Great Depression divided by the month. While September on average is the worst month for stock, that doesn't mean that each individual September is bad. So just on average, September is the worst. It doesn't mean that this September is going to be bad. This September could be positive. So it's good to understand this information, but then also react to the particular of the market at the time, and not be fixated on that September is going to be bad. In fact, there are two things Investors should know since 1950, the month of September has delivered 31 up years, 38 down years. So on average, it's negative, but almost half of the years has been positive. Next, the last two Septembers, 2018 and 2017, in this case, is a little older, saw the market return positive numbers. So no one knows the definitive reason for the September swoon. Trying to guess which year will be bad is a fool's game. So again, you can't guess if this year is going to be negative or positive. You need to react to the market accordingly. But having this information should benefit you. Remember, there's no difference between market timing and seasonality. Seasonal trends reflect how the market will behave in particular months or seasons as part of a long-term trend. Market timing is based on short-term price patterns. They say market timing is impossible. I don't think everyone agrees with that, but as discussed above, seasonal trends are grounded in analysis of historical data, and not every year is going to be identical. It's important to remember that investors who trade frequently, so they're talking about cost of frequent trading, and there are proponents of a buy and hold. Again, not everyone will necessarily agree with all the opinions expressed in this article, but hopefully this helps you understand what the September swoon is, and that the data says that based on the historical data, it is a real statistically significant real thing. So I hope that helps. The content of this video was produced by BeachBum Trading. We hope you will choose to also join us in the BeachBum Trading community and subscribe to our YouTube channel. Visit us at our homepage at beachbumtrading.com, the bum without the U. Similarly on Twitter, BeachBum Trading, bum without the U. On Facebook and in our BeachBum Trading Facebook group. Please follow us on Pinterest and on Instagram. All of the links to our social media sites will be included in the description box below, and we hope you will choose to subscribe to our BeachBum Trading YouTube channel and follow us on social media. Thank you. We also cordially want to invite you to our new BeachBum Trading community Discord server, where we can have discussions on all topics related to trading, success in trading, investing, etc. You can see alerts when we make trades, changes to our watch lists, etc. So again, please join us in the new BeachBum Trading community Discord server. You should be able to find a link in the description box below. You can also find a link in the social media category on our webpage, beachbumtrading.com, without the bum without the U, and also in the link section on the About page of our YouTube channel, etc. So again, we look forward to seeing you in the BeachBum Trading Community Discord server soon. Wave and say hello. BeachBum Trading also now has a site on Patreon. If you are willing and able to help support our efforts to produce all the content and help you achieve the financial freedom you want, deserve, to be able to live the beach bum lifestyle or any other kind of lifestyle you would like, and you're willing and able to help support our efforts in these regards, we hope you'll choose to visit our Patreon page. You can get access to our new BeachBum Trading community Discord server, which is currently under construction, but you will get access to the Discord server by supporting us through Patreon. Again, this is all currently under construction, but you can see we just have the default levels, membership levels, but again, each level allows support, allows access to our Discord. We're also posting our trade positions initially in our Discord, and again, we greatly appreciate any support that you're willing and able to provide. So
Thank you for your consideration.
Thank you again for watching our video. We hope that you liked it. If so, please smash the like button, give us a thumbs up. If you're not already subscribed, please consider subscribing to our BeachBum Trading YouTube channel. Please share this video with your fellow traders and friends. And please give us your feedback and any recommendations for improvement in the comments section below. And let us know what else we can do to help you in your trading career. Thank you again, good luck, and have a great trading day. If you like this video, we hope you will choose to subscribe to our YouTube channel by clicking on the box in the upper left-hand corner. You can watch another video like this by clicking on the box in the lower right-hand corner. And we have a whole playlist of videos like this that you can access via the box in the upper right-hand corner. Our latest video is available in the box in the lower left-hand corner. We hope you like this and have a great day.